everybody. My name is Stacy Roberts. I'm a director with SALTovation at TaxOps, and I'm here today with Judy Vorndran, partner in SALTovation at TaxOps. We're here today to talk to you about the state tax implications of international sellers and what you need to know about that. First and foremost, international sellers need to determine whether they have nexus with the states and are doing business in the United States. And so one of the ways that we've seen more taxpayers determining that, or where it's been on their radar, is due to the Wayfair case. Judy, do you want to tell us a little bit about that?
Yeah, and it was interesting. I actually just had a client today say to me, Wayfair, what's Wayfair? And I thought, oh my goodness, I haven't had that conversation in a while, because it has been all over the New York Times, the Washington Post, and a lot of media over the last 2 years when that decision was made, June 21st of 2018. It was effective July 1 of 2018, so we're almost 2 years into that decision, which was basically a case against the state of South Dakota, of all states. We have 50 American states. South Dakota has a population of maybe 1 million people, and yet that state agreed to create this law, which by all truths was actually constructed this way, intentional. It was an intentional effort. And then the companies Wayfair, Newegg, and Overstock.com all joined together, were assessed by the state of South Dakota. They could have just said, whatever, we'll pay the assessment, we're moving on, right? Instead, they all hired attorneys, they all went up to court. We had various layers of briefing, lots of organizations got involved, the American Society of CPAs, the legal community, you name it. All kinds of people filed what we call amicus briefs, which are Me Too briefs. So we had lots of litigation and brief writing about this case. So this case got decided. In fact, we talked about actually going to visit South Dakota, the Supreme Court, and watch the argument, because it's such a pivotal case for us people in the state and local tax area. I did not do that, because for a 3-minute time in there was not probably worth it. It's a whole hour of argument, not a whole lot of time to fly all the way to DC from Colorado. But needless to say, that case said that if you sell $100,000 worth of whatever into the state of South Dakota, or 200 separate transactions, you are considered to be doing business for sales tax purposes and need to get a sales and use tax license in the state of South Dakota. So that's a pretty pivotal case. And at that time, in 2018, 15 states had already had laws passed in lieu of this case decision. So we already had, we have 45 states plus DC have a sales tax in America, and 5 states in America do not. You can recognize that by the acronym NOMAD. That's New Hampshire, Oregon, Montana, Alaska, and Delaware. There's also another acronym that I will not give you right now, but you might be able to Google it and you'll see that it is spelled a little bit more tongue-in-cheek than NOMAD. But needless to say, we've got the South Dakota case, and out of the 45 states plus DC that have a sales tax in America, 15 of those states put laws in place already. So those laws immediately became effective on July 1 of 2018. And since that time, every single state except for 2, Florida and Missouri, have put a Wayfair law on the books. Additionally, they have put a marketplace law on the books. So we've got that as well, which is where we put the onus on vendors that transact things on behalf of the many. Think of Amazon, eBay, Airbnb would be probably considered a marketplace. Those types of sellers also have to collect the tax on behalf of their small vendors, but sometimes those small vendors also have to collect the tax on their own behalf, as well as those sold and facilitated through an Amazon and eBay or other. So it's really thrown a wrench into everything, where we would look at these traditional issues of nexus, which were typically considered permanent, not a permanent establishment, but a physical presence. Mm-hmm. And so physical presence can be gotten by the virtue of a remote employee, inventory in a state. You might visit a state. We call that popcorn nexus. You pop in, you pop out. Or an office, warehouse, or some other facility that's physically present in the state. That was traditionally how you had nexus. So even if you're an international seller, pre-Wayfair, you could very well have had nexus in America for state and local tax purposes, either at a sales tax level or an income tax level, because our states don't follow our federal treaties because they don't have to. So we'll talk about that in a little bit more, but that has really been a really fascinating area where, transactionally, you're just selling something to a U.S. consumer, and all of a sudden you've got a duty to comply with our sales tax laws, and that impacts American entities, of course, or any entity selling to an American consumer, whether it be B2C or B2B. So that has been a real change for us in our career, where it's really raised the level of scrutiny and information so people understand more about what is going on transactionally when they really didn't think much of it, or they thought the federal US tax law or a treaty would override any state supremacy, which is not the case.
Right, right. Well, and I guess another point to make too is that a lot of international companies, we've seen, at least with working with those types of entities in our own client base, is that they're sending people over from the different countries where their headquarters are to establish maybe business here in the US, and so they may not fully understand or realize that they've already created a physical presence nexus, maybe not necessarily a permanent establishment here in the US for federal income tax purposes, but as Judy mentioned, from a state income tax for state income tax purposes, that's not necessarily the case, due to the fact that the states, like she said, do not follow the federal treaties necessarily. And then, as she mentioned, just selling now, after Wayfair, just selling into the US without any kind of physical presence, now international companies have to take Wayfair into consideration and determine whether they've exceeded thresholds and then have a duty.
Right, and if they have a duty, they could maybe just have a sales tax licensure, sure, because they are going to sell to a U.S. consumer, and they're going to want to need to collect the tax. You have to have a license to collect the tax, because a tax collector is a fiduciary duty. You're basically considered an arm of the government. So you are the tax collector on their behalf. You have to get licensed. You have to collect and remit that tax from U.S. consumers or businesses, and then remit such tax to the various jurisdictional authorities in America. And unfortunately, while we have 50 United States, 45 plus DC have a sales tax, we have over 13,000 local jurisdictions in America. So that makes the rate calculation and sometimes the tax calculation incredibly difficult. And it almost feels impossible for the unwary like us. We have to sort through the bits and pieces of facts, especially with clients that are SaaS or service-based businesses but sell a little bit of a product, or say, for example, you're integrating an IT system and you're building out the cables and the wires and the cameras and the phone system and the videography and all that. Well, there could be a software element to it, there could be a service element to it, there could be a product element. All of those bits and pieces are or are not taxed in the various states in our nation. We don't really have a VAT, right? And then some things are exempt when you buy them, some things are taxable when you buy them, depending on who you are and what you're doing with those items. So for example, in my audiovisual example, they might buy all that cord and cable and video equipment and phone systems for resale and then charge me, the business end user, for the install and the actual marked up equipment. So I would buy that equipment tax-free and then charge tax to my customer on the marked up price. And so that makes it very complicated for businesses to understand how to unwrap their transactions on the buy and the sell side and understand who they are as a business in America. I think a lot of people don't realize they're retailers. A lawyer could be a retailer. I'm a lawyer, I'm a CPA. I'm a retailer because I sell something that could or could not be taxable. In fact, what I sell is taxable in South Dakota, of all places. So they tax services such as mine. So if I had a South Dakota customer and I had exceeded threshold or were otherwise physically present in the state of South Dakota, I would need to collect sales tax on my legal services invoice to a South Dakota customer. That's just the way the rules work in South Dakota. You, as a citizen of a foreign country, have the onus now of collecting a state tax because you met a certain threshold in that state and you decided to sell to Stacy in Denver, Colorado because she loved what you had to offer and you were able to get it to her because of the world that we live in now, being such an open commerce. Now you might have a duty to collect that tax from her if what you sell to her is taxable. So it's a real trap for foreign companies trying to look at the federal law and then thinking that's the answer, one size fits all. Look at a treaty, rely on a treaty, I don't have to deal with state and local taxes. That is by no stretch the case. So do you want to talk a little bit about the treaties and the supremacy and why we think, why do you think that's happened in terms of the states are going after it and not following the federal government?
Well, it goes back to the fact that they do have supremacy because they can choose to tax taxpayers or not. And just because the federal government might not, the states have the supremacy to tax inbound companies, and they make their own laws. And so we've got several states, a lot of which are on the borders, as you can imagine, that in particular do not follow federal treaties. So like California, Montana, North Dakota, some of those states do not follow treaties, and so therefore, if a international company is doing business in California, for example, has exceeded Wayfair, is otherwise doing business, then they do have a filing requirement in the state of California. Now, California itself has its own kind of interesting rules with respect to how to file a return, particularly if you have an affiliated group of companies, and so a lot of, I think, taxpayers think, oh, okay, well, if I'm doing business in California, I can make what's called a water's edge election, which a lot of states that have, a combined filing method construction, they have those rules. California happens to be a state that has what we call default worldwide filing, and you can make a water's edge election. But what is a little bit of a trap, I think, for some of the international companies is that a water's edge election doesn't necessarily mean that it is only the companies that are doing business within the borders of the U.S. There are a lot of international companies that maybe are set up in the foreign country, but because they might have what we term effectively connected income, which is really because they are doing business in the U.S., absent the fact that there is a treaty in place, then they can be pulled into a state's water's edge election. And so it's a little bit of a trap, I think, for the unwary. And I think the water's edge election and just kind of the term water's edge is a little bit of a misnomer, because you really have to look at those states' rules to determine, even if you have an international or foreign entity, whether they might actually be pulled into that group for filing purposes. So even though, like I said, there could be a treaty or there could be even these water's edge elections in place, those foreign entities might still have to be pulled in and pay tax.
And a lot of people think they don't even think about it, because what the problem is, we have a treaty. Okay, so we're doing business with the UK or Canada. We love doing business with those countries. We have treaties. We don't make you file federal tax returns. Well, guess what? You cannot file a state income tax return unless you have a federal tax return. So what effectively has to happen is you have to create what we call a pretend or pro forma federal tax return to pretend that they're doing business in the US, right? Take that information, put it onto the state forms to make the right slicing and dicing of that federal pretend income across the world, honestly, because of this water's edge or not water's edge issue, meaning, are you taxing the worldwide income of the entity? Are you taxing the water's edge income, the income only earned in the US? So there's a lot of slicing and dicing we have to do as state tax professionals in order to make sure that we put the right allocation of revenue and income to each attributable state. And Stacey was mentioning California, North Dakota, and Montana having what we call water's edge elections. Well, think about it. They're a port state. I mean, California has a ton of ports. It has a ton of inbound transactions. We've got Canada. People move across the state lines in Montana and in North Dakota from Canada. So we have different laws about that. You get in the middle of our country and we have slightly different rules around that because of their border issues with their co-neighboring states. So there is, unfortunately, just a bit of a mess. And, I've started to akin this to doing business in Europe. If you do business in Europe, you've got to look at Ireland. You have to look at Asia. You might have to look at Europe, Germany, Turkey, Spain, so on as France. Well, those are all different countries. Well, I guess I would say to you, as an international taxpayer, America is a little bit like that too. Our states have their own independent thinking. They have their own independent economy. They have different industry, and they create laws to fulfill their state coffers in the various needs that they have to fulfill state services, which is providing roads and schools and fire departments and police and lighting, street lighting. And we have a lot of state law that takes care of state taxes take care of a lot of those things in our U.S. states. The federal government gives some money, but ultimately how the state spends that money is up to them, and then they need more of that money to support their citizenry. So they believe that they are entitled to your tax because you are selling to their citizens, and you can use their court systems and enforce your contracts, and they make sure your goods get to them because they have good roads and good systems of law, so that your product gets to them safely and delivered properly. Or the internet, but which was, by the way, created by government. So I think there's a lot of view on that it's fair, and they need the money. And unfortunately or fortunately, there's 330 million Americans, and we like to buy stuff. So we're a good consuming market, and we have a lot of citizens, and we're willing to buy services and products from wherever. If they're awesome, we're going to buy them.
Okay, so now you're selling into the United States. What do you need to do to get established and start complying? So what you need to do first is, first and foremost, if you don't have an EIN, get an EIN, which is something that is applied for with the U.S. government, with the IRS. And then that can create other filings with the IRS, but we'll talk about that in a moment. But then you would need to get registered in the states in which you've created a presence, whether that's because you've exceeded Wayfair or have otherwise created presence through a physical presence, whether that's people, inventory, etc., some of the other items that we went through earlier. So that registration then will get you registered for sales tax and income tax in some cases. Not every state requires an income tax registration. If there are employees who are on the ground, then that registration can also get the taxpayer set up for payroll taxes as well. So those are usually like the big three of the taxes that are covered under the registrations. There are some other industry types that can be covered under the state's registrations, but those are generally the types that are covered. So then you submit that registration. Usually can be done online. There could be a fee associated with it, but those numbers are usually given fairly quickly, sometimes right away, particularly if they're filed online. Sometimes it takes a few days for the states to verify, but then once that registration is put in and the account is given, then the state's on notice that the company's doing business there, and is then going to assign a filing frequency to the company, meaning that how often do they need to file state sales tax returns and remit sales tax. It could be monthly, could be quarterly, could be annually. Could be some other kind of
biannual, whatever. Quarterly payments.
Depends on the state. There's a lot of different flavors that goes with sales tax remittances and filing frequencies, but that at least gets a taxpayer started. Now, on the income tax side, it can be a little bit more difficult, not necessarily from a registration, but more from a compliance standpoint. So for companies that are doing business and they have multiple entities in a structure, so they have multiple affiliates, particularly let's say there's a foreign company, a foreign parent that sets up a sub in the US, so then that they've got a relationship, right? And so a lot of states look at a unitary relationship. So there's several states, probably more than half honestly of the states in the US, that have what's called a combined filing methodology, and it's all based upon the unitary business principle, which means basically that if companies are they have a lot of synergies, they have common board of directors, they have common officers, they have a lot of activities that are or interrelated activities. It could be intercompany sales, it could be activities that, the U.S. sub, for example, supports the foreign parent, etc. So they look at all of the relationships between the entities, and if they're looking at it as there's a lot of those interrelationships, then the states will say you're unitary and you're basically one taxpayer.